Now, here's a bit of good news, though. We did learn yesterday that the mortgage purchases to purchase a home were up 6% from a week ago. Refis are down a little bit, but get this, they were up 147% from a year ago. I want to bring in Better.com CEO Vishal Garg. And Vishal, let's talk about this for a moment, because you heard the conversation we had. We know this is probably topic number one right now, particularly after the elections we just saw. You're in the industry. What do you think about some of the suggestions we heard, what the White House is putting out there? How do we fix this?
I think the number one way to fix this is to stop the quantitative tightening that the Fed has done. So the Fed has actively been selling mortgages for a $3 trillion balance sheet about 2-3 years ago down to a $2 trillion balance sheet of mortgages. What that means is the spread between a 10-year treasury and a mortgage rate is up to 225 basis points when it used to be 100 basis points. So the Fed could literally just stop selling mortgages, its mortgage book, actively reinvest the proceeds, and you'd bring mortgage rates down by 1%.
Wow.
1% is $4,000 in every American homeowner's pocket per year. And I think that's huge. And then from there, if you have rates coming down, if you get rid of a lot of the excess costs that are in the system, you could return another $10,000 back to American families.
A lot of people say, well, they don't affect the long end of the curve, but we've seen historically where Fed funds rates go, eventually mortgage rates go.
100%, like they're funded by the market, especially home equity. Home equity is on fire. There's $22 trillion of home equity that's tappable by American consumers, and they're using it to pay off the $18 trillion of debt that they accumulated, half of it during the pandemic, right? That is at 15, 16, 18, 36% rates, and home equity rates are exactly linked to these short-term treasury rates.
I'm glad you said it. Now, I've had a few smart people say that they're not, and I've had some that say that they are. It frustrates the heck out of me. I want to talk about your company for a moment, because you're using AI-powered mortgages.
Yeah.
What's the difference with AI?
I think the biggest thing is it's 24/7, 365. And this is not AI that's fluffy. This is not AI where it's like a chatbot. This is an AI loan officer, an AI processor, AI underwriter. It's how we lower the interest rate on your mortgage, where everybody else is quoting 6.5%, we're quoting 6.2%. We're putting $1,000 a year back in your pocket by using the AI to do things that people have traditionally been doing, staring and comparing underwriting criteria, sending you documents, all that stuff the AI can do, and it does it instantly, and it makes the process easier for you.
Well, you're gaining a lot of fans. A lot of investors are saying, hey, this stock is something we want to be in. You've had one heck of a ride. Now, you kind of did yourself a disservice a couple years ago, right, with that infamous memo, whatever it was. But the stock got clobbered. I mean, absolutely clobbered. But you're coming on strong. What's the difference now for your company?
I think the biggest difference is we have AI actually working. So we got clobbered. We were, from 2016 to 2021, we went from 500 million of funded volume to 58 billion of funded volume. Most of that was refinances. When rates went up by 450 basis points, our market for our core product evaporated. We had to pivot. I leaned hard into developing an AI mortgage loan officer, an AI underwriter, and now for the past 2 years, we've got it out there in the world. You can get a mortgage, you can get a home equity loan, and volumes are going up. Costs are staying the same. We're saving consumers more money than ever before. Now you got inflation coming in, a recession coming in. Consumers are actually more cost conscious. When the rates were 3%, they didn't need to like shop around for a rate, but now they really care that they can get a low rate, and that's why our volume's booming and our stock prices now falling.
I'm going to give you credit, man. You know what? Again, there was a hell of a drop. You hung in there, you're retooling the business, and you're getting a lot of investors who like your company. I'm glad you shared your story and your expertise. Thank you, Vishal.
Thank you so much.
All right, folks, obviously we know anytime there's a